Hey, what's up everyone? Welcome back to the channel, and I hope you're all doing well. It's finally June, it's finally summer, the weather's getting warmer, so I hope you're taking advantage of the outdoors. In this video, I'm going to go over 5 dividend stocks that are my picks for the month from the hundreds of stocks that I have gone through from the TSX universe. I'm going to cover their recent financial figures, their valuation metrics, and my analysis on why these 5 stocks are my picks for the month. So make sure you stay tuned for the full video. I'm also going to cover any recent business updates so you get an idea of where these stocks are potentially headed next. The first one up is National Bank, ticker symbol NA. National Bank is the 6th largest bank in Canada. It is heavily concentrated in Quebec, which contributes to 62% of its revenues. National Bank has performed very well over the last 10 years with a CAGR of 11%. This bank has also paid and grown its dividends throughout its financial history. In recent years, National Bank has expanded outside of Quebec into the rest of Canada to capture additional growth. Being a smaller bank than the rest of the Big Five, National Bank has grown its business by focusing on 2 key areas. 1, capital markets, and 2, wealth management. The current price of National Bank is $91.92. It has a market cap over $31 billion, a PE ratio of 12.39, earnings per share at 7.43, and a dividend yield of just over 3% at 3.07%. Continuing with the dividends theme, National Bank pays a quarterly dividend. It pays out in February, May, August, and November of each year. It has a payout ratio of 38.27%, and its most recent dividend was 71 cents per share. It has a 3-year dividend growth rate of 6.1% and a 5-year dividend growth rate of 6.15%. So it's a very stable and consistent dividend grower. And that's exactly what you want to see as a dividend investor. You want to see a healthy payout ratio. You want to see consistent and reliable growth. And that dividend growth should be at or better than inflation. Because as long as that dividend is growing faster than inflation, that increases your buying power as a dividend growth investor. So you can use more of those dividends to spend on daily life, or you can invest right back into National Bank or any other stock or ETF. The choice is yours. Looking at National Bank's recent financial performance, revenues are up 45% on a year-over-year basis, coming in at $2.23 billion. Net income is also up over 117%, coming in at $801 million. It has a very healthy net profit margin of 35.87%, operating income of $1.03 billion, which is also up 151% compared to just a year ago. And pay close attention to this next figure right here, cash on hand. It has $30.76 billion of cash on hand. That's up 38% from a year ago. It has plenty of cash on hand to fund its next acquisition, to implement new technologies, to improve processes. The choice is there. Or National Bank can use that cash to pay out more dividends to its shareholders once the restrictions on dividends for the banking sector are lifted by OSFI. And I have a feeling once these restrictions on the banking sector are lifted in terms of dividend growth, we're going to see some fantastic raises come from the sector. Because banks have been holding on to so much cash, their payout ratios have dropped, and shareholders will be rewarded. It's just a matter of time. As an investor or a potential investor with National Bank, I'd love to see growth across the board into all kinds of different metrics, because this kind of growth will push the stock price to even more all-time highs, will push the next generation of dividend growth. All good things for shareholders. National Bank also has a return on equity at 15.64%, and its 5-year stock price has gone up 105%. That's a doubling of the stock price in the last 5 years. And looking at just the last year alone, the stock price has gone up 40%. And looking at the analyst recommendations for National Bank, this is a mix between a buy and a hold. So if you already own National Bank as part of your portfolio, you definitely want to hold on to it. And if National Bank is not already part of your portfolio, you definitely want to consider adding some shares. The average price target is 101, and it's currently trading just below $92 per share. So if you can get in around this price point, there's still plenty of upside for you to benefit from. Here's why I like National Bank. As a smaller bank, it can adopt strategies and implement changes much faster than the rest of the Big Five. For example, recently, National Bank opened up private banking branches in Western Canada to capture additional growth. National Bank, just like all the other banks, set aside a lot of money back in 2020 to protect itself in the event of a mortgage default crisis. Turns out, there just weren't as many defaulted loans as expected, which resulted in better than expected profits for the bank. By the way, if you're new to the channel or you've seen my content before, do me this one huge solid. Hit that like and subscribe button. It does 2 things. 1, it lets me know to produce more content like this. And 2, you don't miss out on future stock picks. Next stock up is Toromont Industries, ticker symbol TIH. Toromont is a great stock, a great industrial stock for both capital and dividend growth. It has two main business segments, refrigeration and equipment. The equipment business involves a Caterpillar dealership and equipment rental for the construction sector. The second segment offers solutions in design, engineering, and installation of industrial and recreational refrigeration systems. It has a current price of $107.24, a market cap close to $9 billion, a PE ratio of 33.33, earnings per share at 3.22, and a dividend yield of 1.29%. The dividends are paid out quarterly in January, April, July, and October of each year. It has a payout ratio of 38.51%. The most recent dividend declared was 35 cents per share, which is up over 13% compared to just a year ago. It has a fantastic dividend growth streak. The 3-year dividend growth rate is 14.22%, and the 5-year dividend growth rate is 13.02%. You're not investing in the stock for its yield because it's less than 2%. You're investing in the stock because of its double-digit consistent dividend growth rate. It's hard to find that level of consistency and reliability when it comes to dividend growth. Looking at its financial performance, it's seeing growth in all key areas. Revenues are up 12% at $806 million. Net income is up 28% at just under $48 million. It has a net profit margin of less than 6%, an operating income of over $70 million, and it has plenty of cash on hand to continue paying its dividend, continue to grow that dividend, and grow the business. It has a return on equity at 15.92%. Looking at the 5-year stock performance, the stock is up 192% in the last 5 years. That means the stock has tripled in just the last 5 years. And the last year alone, the stock is up 54%. Looking at the analyst recommendations, it's a mix between a buy and a hold, but a much closer lean towards the buy side. If Toromont is not in your portfolio already, you definitely want to consider this stock as your next pick. It has a price target of about $112, currently trading at $107, so if you can still get in on at this price point, you can still see some good potential upside. But not only do you get that capital appreciation, but you're also buying it for that amazing and consistent dividend growth. It's no surprise that Toromont is not the best yielding stock that you can find. But for me, the reliability and the consistency of the dividend growth, they are there. And that's why it's one of my top 5 picks for the month. It's also one of the oldest dividend aristocrats on the TSX. It has grown its dividend payout for the last 3 decades. But oftentimes, its dividend gets overlooked because of that lower yield. So don't let that deter you. Toromont's growth has been quite consistent. Just take a look at this fact. Over the last 2 decades, it's returned over 1,300% to its shareholders. If the company only maintains that growth it's been seeing in the past, it's going to grow your capital several times over in the next coming decades. My next pick is a Canadian Properties Apartment REIT, ticker symbol CAR.UN. Because that is a mouthful to say, it's also known as CAP REIT for short. And it is the gold standard when it comes to residential REITs. It has a very strong position in some of the hottest real estate markets in Canada, Toronto and Vancouver. And management has a proven track record when it comes to capitalizing on opportunities. Multi-unit residential properties, especially in Canada, is a stable and certain industry. And that's exactly what you want as a dividend investor. You want the reliability and consistency in the dividends. Residential real estate is considered to be a highly defensive sector. However, it also has a ton of growth potential, especially as Canada's population not only continues to grow organically, but also through immigration. It has a current price of $56.95, a market cap of close to $10 billion, a PE ratio of 10.32, earnings per share at 5.52, and a dividend yield of 2.42%. The dividends are also paid monthly. That means you get paid your portion of profits every single month throughout the year. So as long as you continue to hold on to the stock, you will get paid each and every single month. It has a payout ratio of 24.96%. The most recent dividend was 11.5 cents per share. And it has a 3-year dividend growth of 2.36% and a 5-year dividend growth rate of 2.66%. It has a very healthy payout ratio to continue paying growing dividends, but also enough profits are retained to fund future acquisitions, which will then lead to even more dividend growth. Looking at its most recent financial performance, revenues are up 5% to over $227 million. Net income is up 30% at $104 million. Profit margin is also up at 45.74%. A very healthy operating income of $127 million, and there's plenty of cash on hand to continue paying dividends. It has a return on equity at 11.36%, and its stock in the last 5 years is up 82%. That means the stock price has almost doubled in those last 5 years. And in just the last 1 year alone, the stock is up 18%. Looking at the analyst recommendations, it's a mix between a buy and a hold, but a stronger lean towards the buy side. 8 out of the 12 analysts have a buy rating on CapREIT. It has an average price target of $61, and it's currently trading at the $57 mark. So if you can get in on this price point, you can still see some upside. And recently, CapREIT just announced an expansion into Montreal by acquiring 5 new apartment properties on the West End. This gives shareholders an additional 154 suites to benefit from when it comes to rent collection. And if you're wondering why their cash on hand dropped year over year, this is why, because they spent $30.6 million on this new acquisition. And this new acquisition makes a ton of sense for the REIT because Montreal is Canada's growing and strongest rental markets. If you're looking for a growing residential REIT, continuously looking for ways to add more value for their shareholders by acquiring high quality assets, CapREIT is a definite consideration for your portfolio. And this is exactly why I love investing in REITs, because you get all the benefits of being a landlord without doing any of the legwork. All you have to do is invest in the company, and then you just sit back and collect your monthly rent through dividends. And you're not just collecting rent from just one single property. You're collecting rent from multiple properties spread across multiple areas. CapREIT isn't just invested in Canada. It has properties in Netherlands and Ireland. And the benefit of rent collection from not only just Canada, but also the Netherlands and Ireland gets passed down to you, the shareholder. So sit back and collect your piece of the monthly rent from CapREIT. My next pick needs no introduction. It's Bell Canada, ticker symbol BCE. Bell is one of the largest telecom companies in the country. It often gets grouped together with the big three, TELUS, Rogers, and Bell. In terms of blue chip stocks, you honestly can't go wrong with any of the three. Bell has proven stability and has a track record of growing new subscribers in a very mature market. The company's strength is product innovation and provides one of the fastest networks for connectivity to Canadians. Its success is reflected in its customer base that exceeds 9 million subscribers, and they're growing. The best way to describe the Canadian telecom industry is that it's an oligopoly. 3 big players dominate the industry, and because of heavy regulations, this isn't going to change anytime soon. It has a current share price of $61.37 and a market cap of over $55 billion, P/E ratio of 22.56, earnings per share at 2.72, and a very healthy dividend yield at 5.7%. The dividends are paid quarterly in January, April, July, and October of each year. One thing I want to point out here, and that you need to be aware of as an investor into Bell, is that the payout ratio is over 100%. If this was any other company, I would be concerned. But given Bell's dominant market position in a very regulated market, to me, this dividend is very safe. Bell last paid our dividend of 87.5 cents per share, and it was up 5% from a year ago. It has a 3-year dividend growth rate of 4.37% and a 5-year dividend growth rate of 4.77%. Looking at its recent financial performance, it's a bit of a mixed bag. Revenues are up compared to a year ago at $5.71 billion. Net income is at $674 million, slightly down compared to a year ago. The profit margin is also down compared to a year ago, and so is our operating income and the net change in cash. And the reason you might be seeing a mixed results is 1, because of COVID-19, and 2, because these telecom players are investing major money into the next generation of connectivity, that being 5G, fiber optics. And once this technology gets rolled out and there's a customer base paying for that technology, you're going to see a boost in financial performance. It has a return on equity at 10.62%. And look at the 5-year performance, there is some capital appreciation, but not a whole lot. And look at the 1 year, same thing. Not a whole lot of capital appreciation, but this is a pure play dividend stock. And look at the analyst recommendations, it's just between a buy and a hold, which makes sense because its current price is hovering around its price target. You might be wondering, why is Bell Canada one of my top picks when some of these stats, they don't look that great? Here's the thing, Bell is one of Canada's largest telecommunication companies, and that's not going to change anytime soon. The stock is up 2021 year to date by 12%, and looking at just a year ago, it's up 3.4%. It should be no surprise that Canadians pay some of the highest cell phone and television bills out of all the developed countries. And because of the strict regulations, it makes it almost impossible for new players to have any sort of major impact. And if they manage to get into the market, they just get bought out by the big three anyways. To me, Bell is one of the best income stocks you can find in the country, with a dividend yield close to 6% and a 12-year dividend growth streak. This is a strong consideration for any income investor looking for reliability and consistency when it comes to dividends. And finally, my last pick, Fortis, ticker symbol FTS. Fortis is one of the strongest blue chip stocks you can find. This Canadian company is among the top 15 utility companies in all of North America. It has operations in Canada, the US, and the Caribbean. The utility industry is highly regulated, and because of that, you can expect consistent cash flows. As long as the populations keep growing, energy demand will grow right along with it, and utility companies are positioned to profit. Fortis has the second longest dividend growth streak in Canada at 47 years. There is a reason why Fortis is considered to be one of the best investments you can make in Canada. The current stock price is at $56.44 and a market cap close to $26.5 billion, a ratio of 21, and an earnings per share at 2.69, and a very healthy dividend yield at 3.61%. The dividends are paid quarterly in March, June, September, and December of every year. It has a payout ratio of 73%, and its most recent dividend was 50.5 cents per share, which is up 5.76% on a year-over-year basis. It has a 3-year dividend growth of 5.2% and a 5-year dividend growth of 6.01%. Healthy payout ratio? Check. Healthy dividend yield? Check. Healthy dividend growth rate? Check. This is exactly why I love this stock as a dividend investor and a dividend growth investor. And looking at its most recent financial performance, you will see growth in all key areas. Revenues are up $2.54 billion. Net income is up $371 million. Profit margin 4.61%. And plenty of cash on hand to fund operations, to fund acquisitions, and to pay dividends to shareholders. It has a return on equity at 6.86%. And looking at the 5-year stock performance, it's up 35% in the last 5 years. In the last 1 year alone, the stock is up 7%. Analyst recommendation, mixed between a buy and a hold, but a stronger lean towards the buy side. Out of the 12 analysts that cover the stock, 5 of them have given this a buy rating, and 1 of them has given this a strong buy rating. The average price target is 59.42, and looking at the current stock price, you can still see some potential upside. Fortis recently extended its target dividend growth rate to 6% until 2025. That means investors like you and I can expect a dividend raise of 6% every year for the next 5 years. That type of transparency and reliability is very rare in a market like this. To me, this is the perfect buy and hold forever stock that will generate a lifetime of passive income. Consistent total return for shareholders, a low risk utility, and a consistent, reliable stream of dividends. Everything you want to see as a dividend investor. That's why Fortis is my last of the top 5 picks. When it comes to dividend investing and dividend growth investing, this is what I look for. I want to see companies pay a healthy dividend. I want to see them pay a growing dividend because as an investor, I want that income stream to grow. Because as long as that income stream is growing, that gives me more options on what I can do with the dividends. I can invest them. I can use them to live off them. I can do whatever else I want with that cash flow. As long as that stream is growing faster than inflation, that will increase your buying power. Thank you so much for watching. This channel would not exist without your love and your support. So please do me another solid favor and check out the links in the description of this video. I have offers to various discounts and sign-up bonuses. Every single click directly helps support the channel. If you have questions for me or feedback on this video, or maybe you have ideas on future content, please let me know in the comments. And while you're at it, make sure you've hit that like and subscribe button. That's it for now. I'll talk to you guys in the comments.